Welcome everyone to another video. Today we'll be talking about none other than Nike. This is a company that's been very popular recently, and the main reason for that is the stock price. If we have a look at the chart here, we can see that the stock is now at an astounding $73, down from a top of about $170 back in October of 2021. Now, from the peak, that's almost a 60% drop in just over 3 years. Meanwhile, in the same time frame, a popular index like SPY is up 20%. So that's huge underperformance for a popular company like Nike. Now, this fall from grace, and particularly the most recent one, is due to a few reasons. And these are the reasons that are blasted everywhere on the media, which would be the rise of other competitors. Everyone's heard and seen the popular shoes coming from On or Hoka. Then there's also, the failed strategy of direct to consumer from Nike. So they're kind of fumbling and changing their strategies of how to best sell to consumers. And finally, and most importantly, and what really caused this 25% decline in just the last month is Nike's guidance for the upcoming year. The company is now expecting revenues to grow at a slower pace, if not even decrease for 2025. And so people are now wondering what's going to happen to Nike? Is this the fall of an iconic American giant? And is it time to sell the stock? Well, luckily for you, in this video, we're going to be addressing just that. Is Nike an attractive investment for someone that has a very long-term perspective? And let's jump right into it by first answering the question, what caused Nike's stock's descent to hell? Now, valuation is not a fun subject. It's always more interesting to blame a stock's performance, whether that be negative or positive, to other things like, a successful management or a turnaround plan or a slowing economy. But at the end of the day, valuation is like gravity. It's a physical law that means that any stock price is tethered to an underlying metric. And to me, that underlying metric is free cash flow per share. Obviously, if the free cash flow per share of a company is very reliable or it's growing very rapidly, then that company will deserve a higher free cash flow multiple. And the free cash flow multiple is just how much someone is willing to pay for a stock based on the free cash flow of that stock. The historical average is 15, but a very high quality or a fast growing company can go to 20, 25, 30. It's all relative. It's all a spectrum. Now, the thing with Nike's free cash flow is that it's pretty reliable. Other than 2020, which was an aberration because of COVID, you can see that the free cash flow is just up and to the right mostly. And it's also growing at a decent pace. But if we look at Nike's stock from, say, 2004 to 2021, you can see that the price is growing a lot faster than the free cash flow per share. Now on rated A, you can see the history of the free cash flow multiple over time. So the line that goes off the chart here is due to the lower free cash flow in 2020 from Nike. But on average, you can see that this is a pretty expensive stock that trades between 45 and 50. Now, yes, Nike has reliable free cash flow and growing free cash flows, but does it deserve a 50 free cash flow multiple? That's the real question that you need to ask yourself. When a company has a multiple that's this high, then certain assumptions of growth and reliability are baked in. The problem is that these are usually very high assumptions. And as soon as a company's revenue starts to falter a little bit, then you can easily see the free cash flow multiple go from 50 to 25, which is still relatively high. And that results in a 50% drop in the share price. So in my opinion, this is the most straightforward reason why the stock has dropped this much in such a short period of time. The first is the rise of interest rates, which, cools down investor sentiment. Not only that, but Nike has run into some hiccups lately, which we're going to get into, but that has resulted in lower revenue growth, and this is the outcome. Naturally, the next question we need to ask is, why did Nike's revenue projections go down? One theory is the slowing global economy. Nike is a truly global brand, and similar to other global companies like Apple or Estee Lauder, Nike is suffering from a slump in worldwide sales. China is in one of its worst recessions in 20 years, and the consumers in Europe and North America are also not at their strongest point. And while this theory does explain a slight slowdown in sales, at the end of the day, economic cycles are a natural part of the environment when you're investing. Economies grow and economies shrink. Whenever you're investing, that should be a given in your assumptions that at some point the economy will slow down. So personally, I think this is a bit too short-sighted to explain why there was a re-rating in Nike's stock. I think the main reason is a failure in the strategy. So if you remember in 2020, a lot of retail shops were closed, and people did most of their shopping online. And at this point in time, Nike's management decided that this was the future of shopping, that people were from now on going to do most of their shopping on their computers from their homes online. And so what did Nike do? They decided to pull out of their relationships that they had with a lot of retailers like Foot Locker. So why is this advantageous for Nike? Well, if Nike sells sneakers or other apparel straight from their own website, then they basically cancel out the middleman, which is this retailer. And so they end up having more control over their own brand, and also they get higher margins. Because when you buy online, all that money goes to Nike. But when you buy Nike shoes from, say, Foot Locker, Foot Locker gets a pretty big cut. And while this might have been profitable for Nike over the short term, maybe 2 years, over the long term, Nike actually hurt itself there. Because what ended up happening is that these retailers like Foot Locker ended up filling the space that was left behind by Nike leaving with upstart brands like On or Hoka. And realistically, how many of you, when you need new shoes or new apparel, go straight to Nike's website? While some people might shop in this way, a lot of people do still go to retailers in order to browse and see what's around. And so what ended up happening is that these upstarts like On and Hoka, which ended up, growing very fast over the last 2 years, they benefited from this exposure. Whereas Nike, while Air Jordans and other popular models remained very popular, they had trouble innovating and giving exposure to consumers to their new models. And Nike fell behind in this way. And I just want to say that in the last quarter, Nike's management decided to pivot once again and renew relationships with some of these retailers. As long term investors, what really interests us is the company's fundamentals. What is the quality of the company? We need to look at the problems I just talked about for Nike and separate them between short shelf life and long shelf life. What do these two things mean? Well, short shelf life just means that these are issues that are very popular right now. They're in the media, they're blasted everywhere. But 2 3 years from now, they probably won't be relevant to the intrinsic value of Nike as a company. Conversely, long shelf life issues are things that will drastically alter a company's fundamental intrinsic value going forward. And I like to separate long shelf life into three separate categories: the moat of a company, the profitability of a company, and the safety of a company. Anything that impacts these three categories will impact the quality of the company. And the quality is long shelf life. That's what really matters. Luckily for you, today I'm going to give a full rundown of all three categories, starting with the moat. For those of you that aren't familiar, what's a moat? A moat is any characteristic that protects a company from competition. In a capitalistic world where there are excess profits to be made, there will be competition coming in. And so companies need a way to protect themselves from that in order to keep those profits and that market share for themselves. The first thing to notice is that Nike has a lot of competitors. Automatically, what this tells me is that sports apparel is not a monopoly, nor is it an oligopoly. So basically, new entrants can come in and compete with the incumbents. And the first point to highlight for Nike is that the company sells a commodity at the end of the day. If you take away the swoosh from Nike products, they're very similar to what other companies can offer. If you get a sports shirt or sports shoes from Nike or from Adidas or from New Balance, they're mostly the same except for the branding. And this is a big negative because other than the brands, it means that these companies will usually end up competing on price. Who can give consumers the better offer? And once again, this is one of the reasons that Nike really struggled with the direct to consumer approach. Is that if people don't have a way to discover new Nike products, they're just gonna turn to competing products. Having Nike shoes in Foot Locker allows people to notice them, and it gives people that incentive to buy them. Now I want Nike shoes because I've seen that they look really cool. But if I don't have that exposure and I have to myself go to Nike's website in order to discover these shoes, I'm less likely to do that. And this is the thing with sports apparel or other fashion industries in general. Companies in this space must consistently introduce new products, secure fresh sponsorships, and engage in continuous advertising to remain relevant in consumers' mind. This is expensive and it's risky. Consumers are always looking for the next cool thing. And this is a risk for Nike is if the company falls behind on fashion trends, it can quickly see its revenue growth slow down. Now, Nike also does have some positives going for it, namely that it's one of the most powerful brands in the world. Simply by adding that Nike swoosh on sneakers, Nike is able to charge a higher price for those shoes and people will be willing to pay them. Why? Well, that's because Nike has associated itself with success, with successful athletes, with successful teams, with, the best leagues in the world. And Nike is able to do this because of its scale. Nike is just huge compared to any competitors. The only one that comes close is Adidas, and Adidas is still pretty far in terms of revenue from Nike. Nike can just outspend anyone on advertising, on sponsorship deals, and so Nike ends up being a lot more visible than any other brand. And this is Nike's real strength when it comes to the moat, is that even if Nike falls behind in terms of fashion, Nike will always be able to come back. Take this summer's Olympics, for example. Even if On Running or Hoka have been, putting out these cool shoe models that work, really well, what everyone's going to see on TV this summer is the best athletes in the world beat records with Nike shoes. And that's what really matters. Is that when it comes to buying new shoes in August or September or October, people will be having these Nike products in mind and going for those. So this is why Nike gets a 4 out of 5 in the moat category. And Nike's really special in this case. I don't think any other sports apparel company would get as high of a score in the moat. And just before we move on, one more thing I want to highlight is Nike's cash flow return on investment. The company is consistently able to reinvest at a very high rate of return. And this is a sign of a company that has a moat. It can defend itself from competition because returns like these will attract many, many competitors. Ideally, we want companies that have a cash flow return on investment above 10%, and Nike can consistently put numbers in the 20s. Great. So, what about Nike's profitability? The company historically grows its revenues at a very decent pace. We already went over the free cash flow per share growth over time, but these are all historical metrics. What really interests us as long-term investors is the future of Nike and how easily Nike can really make money. The first thing to highlight here is that Nike operates in a pay-to-play industry. Like we went over in the moat, one of Nike's biggest advantages is its scale, that it can outspend any competitors. But outspending competitors is expensive. Nike needs to put out huge amounts in order to secure contracts with athletes, with teams, and with leagues. And putting out such sums of money is always risky. There's always a chance that an athlete can get injured or that a team can perform pretty poorly. All of these expenses end up eating into Nike's margins. And that's why historically, the company only does about 5, 6, 7, 8% in cash flow margins. While that is pretty high for an apparel company, for companies in general, that's relatively low. But there's also positives for Nike, and that is the growing sports market worldwide. The middle class is growing everywhere in the world, especially developing countries like China, for example. And also, women's sports are becoming more popular. And as people have more disposable income to spend on sports and more people end up joining the sports market, Nike stands to benefit as one of the largest players. It's not always true that a growing market will benefit the current players in the industry, like Nike or Adidas. After all, as a market grows, new entrants need less of market share to be viable. But when it comes to Nike and Nike's situation, I think that when new people start up sports, they're more likely to buy materials and apparel from a well known brand like Nike. So, all in all, Nike gets a 3 out of 5 for profitability. So, in terms of safety, Nike is very dependent on brand value. Brand is basically the only thing that separates Nike products from just being a commodity. And if Nike were to lose brand value, be that through a botched marketing campaign, or it comes out that human rights have been violated in Nike's manufacturing plants in Thailand or something like this, then this could really hurt the brand. We saw it with Adidas and their sponsorship of Kanye West. As soon as Kanye West went off the rails, the company lost a lot of real value. And like I said, there's also the allocation of capital. That's a real risk. Nike's management has to make important decisions regarding capital allocation. They must decide which athletes and teams to sponsor and how much to allocate to these sponsorships. If invested in the wrong athlete, these large sums can impact the company's financial health. Also, a company like Nike must determine how much inventory to keep in stock. Some Nike products, like Air Jordans, they have luxury good characteristics, which means that Nike has to restrict the supply in order to increase the demand. The less Air Jordans are available, the more expensive they can be, the more desirable they become. For other mass market Nike products, the company will benefit from maximizing sales volume. But keeping all of this inventory in Nike warehouses ties up a lot of capital. That capital is marked as an asset on the company's balance sheet. But the problem is that if Nike doesn't sell those shoes and those shirts within a given season, these assets end up losing a lot of value because they must be sold the next season or the season after at a much reduced rate. Not only does this mean that Nike's balance sheet takes an immediate hit, but the discounting could lead to brand dilution as well. And the last thing I have here under safety is geopolitics. Of course, you'll have heard that China is a crucial market for Nike, but with everything going on and the relationship between US and China and the current government over there, you never know what can happen. Not only is China one of Nike's largest, future growth markets, but it's also where the company has a lot of manufacturing facilities. So that's always a risk to keep in mind. But all in all, I would say the sports industry is pretty stable, and that's why Nike still gets a 4 out of 5. So all of this explains the overall rating of B. A B company is still a high quality company. As a matter of fact, at Rated A, we recommend that an investor looking to add a stock to his or her portfolio should also consider B rated stocks, even though preference should be given to A rated stocks. Nike is undoubtedly a quality company. And while I think that the issues that have caused the stock price to drop in the past year are very real, I think that with the proper steps, management can turn things around. And I think it's very probable that by 2030, we'll have forgotten these competitors and this failed strategy mishap. I think the main problem with Nike is still the valuation. After all, the company still sells at a free cash flow multiple of 27. And while that's not extraordinarily high, it's still not cheap for a sports apparel company. Same thing for the dividend. So while the stock price has dropped quite significantly, it's not yet at a value deal. At Rated A, we recommend that the best value stocks have at least a rating of 3.3 and ditto for income ratings. I think Nike might still not be the best stock for a dividend investor looking for stable income and growing income. I think there are better deals in the market at the moment. And just to illustrate this, I've used the 10-year total shareholder return calculator. With today's buy price, the current revenue for 2023, historical average revenue growth rate, historical average margin, some buybacks in the next 10 years, a fair multiple of 25, a current dividend of 1.33, and a historical average dividend growth rate with 100% of the dividends reinvested, you only get to about 10.6% total shareholder return for the next 10 years. And while this seems like a decent return, remember that the market does about 8 to 9% per year. So I think that if you're going to be picking individual stocks to build your own index, you definitely need more of a margin of safety than this. And I usually recommend stocks that have 14 to 15 TSR for the next 10 years. But that's just my conservative assumptions. If you do slight tweaks to the revenue growth rate, the margin, and slightly more buybacks, you easily get to about 15.7% per year. So in that case, that would seem like more of a good value deal with these assumptions. So for complete transparency and for full disclosure, I currently do not own Nike stock, and I'll probably not own this stock until the value rating reaches my trigger of 3.3, which means I'm still waiting for the stock price to drop another 10 to 20%. If I may, the one caveat to all this is that this is all based on 2023 free cash flows. At the time of recording this video, Nike still has not released the free cash flows for 2024. It's entirely possible that with bumper free cash flows in 2024, this multiple could go down to an even more reasonable level. So just keep that in mind. Now, this platform that I've been using for this video is called Rated A. I'll put the link in the description below. Definitely check it out if you like picking out stocks and creating your own index. Now, before you sign up and complain about the number of companies, let me tell you straight away, there's only about 26 companies on there at the moment. But the platform is being built out little by little, and there's only going to be more and more companies added from all over the world, the US, Canada, Europe. So the proposition is becoming more and more interesting over time. It's only $5 a month, and it's a free 2-week trial. Anyways, that's it for this video. Thanks for listening this far if you're still on the video, and I'll see you in the next one.